In this video, I will be speaking about a very specific pattern that involves using Fibonacci retracements to understand when the market is ready to create a continuation of a trend. Now, this is a pattern that many people completely ignore, so I want to speak about it specifically because it's kind of a secret pattern that nobody speaks about. Now, if you're new to the channel, I'm a top author on the TradingView platform and I share free education and analysis on all my platforms every day. So I suggest you subscribe to the channel and I will see you in the video. This pattern that I'm about to share with you guys is a very important pattern and it will definitely make you a better trader. And how I will explain it to you guys. Number one, I will first explain how the pattern actually works, and then the second step of this video will be actually going in a live market example of this pattern to show you also a setup that we have executed with students on USD NOK to show you how in real-time charts this pattern actually works. And then I will also give you guys a full breakdown of USD NOK to show you guys where is the next opportunity for this pair. So obviously we will first check what we have from a technical perspective and then order flow perspective, and I will show you where we can be looking for the next opportunity on USD NOK. But let's start from the first part of the video, which is obviously speaking about this very important pattern. Now, I will explain the basics of the pattern. And obviously it is involving the use of the Fibonacci tool. Now, when do you use the Fibonacci? You use the Fibonacci if you want to measure a leg in the market. Specifically, if you have an impulse in the market and you have a retracement and you want to measure this retracement, then what are you supposed to be doing? You're supposed to be taking your Fibonacci from the low to the high of this impulse, and this gives you information on this retracement. Now, this is how the pattern works. If you see an impulse in the market and you see a correction, and after this correction, the market starts testing all the Fibonacci levels one by one, meaning that first the market tests the 0.786 and breaks above the 0.618. Then the market goes back down and tests the 0.618, rejects it and breaks above the 50%. Then the market tests the 0.5% and it rejects it and breaks above the 0.382. And then again, the market tests the 0.382. At this point, guys, you expect an explosion to the upside because the market has tested all the Fibonacci levels one by one and it has rejected all the Fibonacci levels. Now, you might think, how is this possible? The market never creates this. Now, I will show you how actually this is created very often, and it is a way in which the market behaves very often. So testing all the Fibonacci levels one by one before starting the next impulse to the upside, because always remember, after an impulse in the market and a correction, you definitely expect the continuation to the upside. So after an impulse and a correction to all the Fibonacci levels, you definitely do expect a continuation to the upside for the creation of a higher high, which is exactly what you expect after this pattern. One very important thing that I want to share as well is that the market doesn't have to start testing the Fibonacci levels necessarily from the 0.786. In fact, it can easily start from the 0.618 and then test the 50% and 0.382, or start even from the 50% and move immediately to the 0.382 to then start the continuation to the upside. So this is basically what I have identified as the ideal case, but obviously the market can even start from the 0.618, from the 50%, or from the 0.382. So let's see how we used not only this concept, but also this concept in taking our long position on USD NOK with students last week. Just a quick reminder, make sure you comment below and you let me know which pairs or topics you would like me to analyze or cover in the next videos. So here on USD NOK, what did we have when we executed our long? The first thing that we can clearly see is that from here the market had started a nice impulse to the upside. And as I have previously said already in this tutorial, is that after an impulse, if you want to measure the correction, you have to take your Fibonacci from the low to the high of the impulse. And by taking our Fibonacci from the low to the high of the impulse, what we can see? We can see that the market was testing the Fibonacci levels one by one, exactly as I have just explained in this tutorial. So how this pattern works in the first place. In fact, by taking our Fibonacci from this low to this high, which is the impulse leg, in fact, what we can see is that first the market tested at 0.786, then the market broke above the 0.618 and tested the 0.618, then the market broke above the 50% and tested the 50% here, and then finally the market broke also above the 0.382, retested it here, and started the explosion to the upside exactly as we expect with this pattern. And obviously, yes, we did capitalize on the move to the upside with students for a beautiful 1 to 3 risk to reward setup on the trade. Obviously, I cannot share my rules for entry. I cannot share why we execute the trade here and not here or here or here. That is part of the mentorship program and my entry rules, with which I only share with students. But what I can share, for example, is one quick structure concept. Here we had previous support, turn resistance, again turn support here, but obviously that is not enough to take the trade, because otherwise we would have just executed the trade from here, right? So this is basically a beautiful 1 to 3 risk to reward trade that we were able to execute with students, also thanks to this very nice pattern that is basically created by using Fibonacci levels by the market that I have just explained. But let's see where is the next opportunity for USD NOK, where we can be looking for the next opportunity. Well, to do that, we have to create a full breakdown of the pair, starting from the monthly time frame, going all the way down on the 4 hours, and also checking what we have from a COT perspective. Now, starting from the monthly, what we can see? We can see that the market has just rejected a very strong demand area. In fact, from here, the market had started all this move to the upside. Then the market went for the retest of this area, and again, you expect the market to find very strong demand here. In fact, the market created a nice move to the upside, rejecting this very strong demand zone. Going down on the weekly, what do we see? Now, from a weekly perspective, we can see that the market, after creating an impulse to the downside, has created a nice manipulation with the creation of a lower low to go and stop hunt all the people that had their stop losses below this low before starting a move to the upside. This is very common. When you see a market approaching a strong structure level from the monthly perspective, on the weekly you will see first a rejection to the upside, then the market will start the continuation to the downside. People that are checking only the weekly time frame will start shorting, and if you haven't looked, then on the monthly you have support. Hedge funds will simply use your liquidity to actually buy and start a nice move to the upside. And what we can also see is that the market has just created this W formation. After a W formation, you want to see the market give you a move to the downside. Specifically, we want to see the market complete a W formation at the neckline, aka the previous resistance, which is now turned support. So on the weekly, we would like to see the market give us a nice move to the downside to go and complete the pattern at this area here, which is something very interesting. So let's go down the daily and see what we have. Now, from a daily perspective, we can see that also on the daily, we have a bearish pattern. Why do we have a bearish pattern? Because on the daily, we can see that the market created a move to the downside, move back up, move down, and then started this move to the upside, which is in overextended W formation. After an overextended W formation, you want to see the market give you a pullback to the neckline, aka the previous resistance, which is now turned support. So we want to see the market give us this nice move to the downside. Specifically, if we look closely, we can see that in all this move to the upside, there is one candle which is not related to the move, which is exactly this red candle. And if the market will break below this red candle, this is previous support that will be turned resistance. So it is very important to wait for the market to break below this area, because at the moment it is still acting as support. Until the market will remain above this area from a daily closing perspective, this area will be support. So we have to wait obviously for the close. And how we will be approaching this kind of situation with students. Now, before I show you that, let's first go and see what we have from a COT perspective on the USD. So what hedge funds are currently doing on this currency. Now on the USD, we can see that net positions are greatly decreasing to minus 9.1k, which is one of the lowest values that we had for a very long time. So hedge funds are clearly shifting their positioning to the negative side. In fact, they currently have 21k shorts and 11k longs. So during this move to the upside, they have started adding shorts. So we can definitely expect the market to give us the move to the downside as we want to see from a weekly and daily perspective. However, as usual, trading is reactive and not predictive. So two things we have to wait for. Number one, we have to wait for the market to confirm that the break of this support is actually created. Until the market will remain above here, the market can and should continue to the upside and can easily continue up. However, if the market will clearly break below the structure, then after the break, this previous support will be turned resistance. So after a break, on the retest of this structure, this is exactly where we will be monitoring price action with students from a 4-hour perspective, waiting for the market to provide to us one of our valid entries. And as soon as the market will provide to us one of our valid entries, we will be taking a nice short with a very good risk to reward and very good probabilities for the move to the downside and completion of this impulse, correction, and impulse pattern to the downside. If you enjoyed the video, make sure you smash that like button and comment below. It really does support the creation of more free education and analysis for all of you. Also, make sure you go and check out the mentorship program. You find it linked in the description. You first learn all the rules of my rule-based strategies in the program, and then you trade them live with me. In fact, every single day you get a new daily market breakdown showing you exactly how to apply the strategies with entry, stops, take profits, as well as having me answering every single question that you have every day, including the weekends. So I really suggest you go and check it out. The link is in the description, and I will see you in.